Thank you, Sebastian, and welcome everyone to today's webinar on understanding your credit presented by HomeStreet Bank's Affinity Lending Program. I am Ryan Cooney. I'm an Affinity Loan Officer here at HomeStreet Bank. And then we're going to have Sebastian, I believe, monitor the chat group. If you have any questions, feel free to drop that in the chat, and Sebastian will come in at a good time to ask. We also will have a lot of time at the end for any questions that you have. So we'll just go ahead and get started from there then.
Yes, thank you, Ryan.
Okay, what we're going to be talking about today is credit. We're going to be talking about what credit reports are, some things that go into factor into your credit score. Then we're going to touch on improving your credit score and wrap up with some Affinity program benefits that are exclusive to you guys as University of Washington employees. Okay, so that gets started. So your credit report, type of consumer report, it contains information about you, where you work, where you live, how you pay your bills. It may also show whether you've been sued, arrested, or filed for bankruptcy. Companies called consumer reporting agencies, CRAs, more commonly referred to as credit bureaus. They compile and sell your information report to businesses like HomeStreet for when you are applying for, just in my example, if you're applying for a mortgage, we use a credit report to evaluate your credit worthiness. It can affect your eligibility, and it can also affect your total pricing. So for that reason, it's very important that your report is complete and accurate. So the first thing I want everyone to take from this presentation today is there is an option to review your credit information for free, and that's at annualcreditreport.com. And we'll gather a couple of things, links, and other important information that Sebastian and I can send out after this presentation is over. But if you go to annualcreditreport.com, you get access to your credit report once a year from the three major credit bureaus. That's Equifax, Experian, and TransUnion. And right now, it's even more often than that. Temporarily, you can access that credit report from each of those bureaus once a week. And the reason for that is to help you as the customer track and make sure that everything on that report is accurate. And if there's an error or an omission in that report, you can correct it, and you should correct it, because if there is inaccurate information on that report, it could be hurting your credit score, could be impacting you in your ability to get credit for, say, buying a house, buying a car, or it could make things like getting credit cards or credit cards more expensive if you have a lower credit score because their interest rate is higher. And for more information on how to dispute various inaccuracies on your credit report, you can go to that website below. Again, that can be sent out after this presentation is over. Okay, very important page here. What are the primary factors that go into determining a FICO score? So this is giving you an overall summary of what goes into the algorithm that spits out the number that is your credit score. The biggest thing, number one thing, 35% is going to be based on your payment history. Do you pay your bills on time? That's the number one thing for determining what a good credit score is. Have you paid every bill on time throughout your credit history? Also, just note, I'm going to go over a couple of these items a little bit further down in the presentation, just going over a quick summary of them right now. The next biggest thing is going to be 30% based on what you owe on all the excuse me, what you owe on all the accounts. So how much debt do you have? And then it can also be how much debt do you have compared to how much credit you are extended. This has bigger impact on revolving credit or your credit cards. It has less of an impact on your mortgage or car loans, things like that. But the total debt, if you keep the total debt down, generally you're going to have a higher credit score as well. The next biggest item is going to be based on how long you've been using credit. So how long have the accounts been open? That's 15%. 10% is based on applications for new credit, and equally 10% based on types of credit used. So starting with the applications for credit, not all credit inquiries are created equally. If you are loading up your credit inquiries with a bunch of different credit cards, car loans at the same time, so consumer credit, you're going to see what the credit bureaus are doing is collecting information that says you might be opening up a ton of new accounts, and we want to see how you deal with those new accounts into our algorithm of how we calculate the credit score. So we're going to try and slow you down a little bit till we figure out what you do with all that new credit that you've applied for. And so that is they're going to lower that credit score until you make some on-time payments, you show what you're doing with that credit, and then the credit score will likely go back to what it was before after generally 120 days to a year, sometimes depending on the situation. This is one of the most common questions I get as a loan officer is how much does a credit inquiry impact my credit score for a mortgage? Mortgage inquiry is a little bit different because it's the opposite of what I just explained. If you have multiple credit inquiries with a mortgage with different mortgage lenders, they are looking at that and assuming that you can only open up one mortgage account because you're only going to be buying one house likely. So that's going to lump all of those credit inquiries from mortgage applications into one inquiry, and it's likely only going to affect your credit score by a couple of points. Okay, and then moving down to the types of credit. So this is going to be a different, it's better if you have a variety of different types of credit used. So have you been granted credit on a credit card? That's a revolving credit, a type of credit where you have a limit and you can take money out and you pay it back and you can use that limit again and again as long as you keep paying that balance down. Have you been extended credit on an installment basis? So that would be like a personal loan or a car loan where you have a set amount and a fixed payment for a set number of terms. It's a slightly different type. And then, of course, you have your mortgage credit as well. And so if you have a diverse type of credit usage, it's going to generally show that you've used credit in different ways. And if you've used it responsibly, made your payments on time, balances are going down, you're going to have a higher credit score that way. Okay, and then if you are here because you do not have a FICO score, the minimum that you need to have a FICO score is open up at least one account and then have that account open for 6 months or more. Once you have that account open for 6 months or more, and it is undisputed, meaning if they say that you have a late payment and you say, I didn't miss this payment and submit a dispute that way, that account is basically taken out of the consideration for your credit score until that dispute is resolved. So you have to have that one account open for at least 6 months or more. If you have zero credit history whatsoever and you're finding it's difficult to get even a credit card, I would recommend that you often go to a financial institution that you already have a relationship with. So if you have a checking savings account with a bank or credit union, it's more likely that they're going to be able to find you a solution to use credit, whether that's an intro level credit card with a very low limit, or they could set up some sort of line of credit that you can pay a couple bills on a month, pay it down, just pay it off so you're not actually spending any money on interest. And you do that for 6 months and you'll likely have a FICO score. And last, no indication of deceased on the credit report. And so this is a note that if you share an account with another person, this may affect if the other account holder is reported deceased. That has come up recently in one of our loans where someone had a joint credit card with their grandmother passed away, and they basically noted on the loan file that credit card was not, the person on that credit card was deceased, and so we had to separate that out. So more of a rare one, but we'll get moving on to improving your credit score. Actually, you know what, Sebastian, before I move on from that page, were there any questions?
No questions yet.
Okay, great. Okay, I'm going to just continue talking about improving your credit score. Pay your bills on time. As I mentioned, and I'm going to mention several times, that's the number one factor that goes into your credit score. So some helpful things that help you or with making payments on time is to use payment reminders. You can set those up with whatever credit institution that you have. If you're more of a calendar person, just make sure that you set yourself up with a note or reminder to make those payments on time. You can consider enrolling in auto payments through your credit card or loan provider. This is so that's just set it and forget it type of thing. And for the credit cards, if you don't want to have it set, I know there's different settings you can have. You can pay the statement balance, you can pay the entire balance. At least have it set up so that you have the minimum balance paid for credit cards and your loans. So that way you don't miss it and you get a late payment, which can affect your credit score and future ability to get credit or the pricing on that credit. Set up a budget to ensure that you have the money necessary to pay all your bills on time. And if you're having trouble making ends meet, you can contact your creditors or seek a legitimate credit counselor. Oh. Payment history. So payment history shows that you've paid your accounts over the length of your credit. The evidence of repayment is the primary reason why payment history makes up 35% of your credit score and is a major factor in its calculation. A few late payments, not automatically a score killer. It's going back to that page where they were breaking down 35% payment history, 30% the amount that's owed, and then it has the number of inquiries and the type of credit you used as well as the credit history. If you have more data to put into the algorithm, so you have a 10-year credit history, you've missed one payment over those 10 years. When you've had mortgages, you've had a car loan, you've had multiple credit cards, and you just missed one payment. All those other things that go into the credit score are going to help off balance that one-time missed payment, and it may not affect may not have a huge effect. Whereas if you are someone who has only say one credit card and it's only been open for 2 years, but you've missed one or two payments, that's when it becomes a score killer because they have less information to pull from to seek if to use in that algorithm to come up with that credit score. Okay, and then not having or having no late payments is also not an indicator that you're going to have a perfect score. So do you meet all of the criteria in those credit score factors? Have you showed that you've used installment debt? Have you shown that you've used revolving credit on credit cards in the past? Do you have history of a mortgage? It's a lot more. You have to show a great depth of history of credit and credit usage in order to have quote unquote the perfect score. Okay. So reducing the amount of debt that you owe. Keep account balances low. This is talking about credit cards. And that magic number happens to be 25%. So if you have a credit card limit of $1,000, try to carry 250 or less on that credit card. And that's going to give you the best score or the best possible outcome for credit score. If you have credit cards, if you do not have a lot of other credit and you only have credit cards and you're taking all of those credit cards to the limit every single month, even if you pay them off all the time, they're still going to be dinging you for using the credit up to the credit limit on credit cards. Again, completely dependent on your personal credit usage and everything that goes into that credit score. But in general, try to keep those balances at around 25% of the revolving limit or credit card limit. Try to pay off debt rather than moving it around. So showing that you've been granted credit and you can pay it back down is going to help that credit go up. If you just do things like balance transfers, it's not going to give you the same benefit as if you were just to pay off the debt. And importantly, do not necessarily close out credit cards just because you don't use them. If there's no payment, no annual payment on the credit card, go ahead and just keep it open because it's going to keep adding every single month, even if you don't use it, that this credit line was granted 10 years ago. And so it's going to say, oh, this person's credit goes all the way back 10 years. Then if you don't use anything else, and then you cancel that 10-year-old credit card, all of a sudden you don't have any credit history that's going back 10 years. So you want to keep that active if possible. Limit, I talked about this briefly earlier, but I'll go ahead and describe it a little bit again as credit inquiries. So try and limit the applications for new revolving debt and do not increase available credit. This includes credit cards, department stores, store cards. So it may be tempting to open up that department store credit card just to get a slight bonus. But if those typically have very small limits, and if you are opening up, again, multiple new credit cards at once, you're introducing a whole bunch of new data into their algorithm that they may not know how you're going to react to all that new credit that's been extended. So try to keep the revolving credit card inquiries to a minimum. Okay, and how do I correct errors on my credit report? So to correct errors on your credit report, you need to contact the credit bureaus directly to show them that they had erroneous information. That's all three of them. That's Equifax, TransUnion, and Experian. So if you do see something that is incorrect, not only do you have to contact them, you also have to contact whichever institution made that error. So be sure that you are taking notes and you're organized. Often it's best to have a file folder saying I've contacted Equifax, I've contacted Experian, I've contacted TransUnion, here are their responses. I've contacted whatever credit card you have says that I was late and I was not late. Here's my proof, and I've contacted them. Here's their response. And there's more information on that on how do I dispute an error on my credit report. Because again, if you have inaccurate information that's obviously not true, and that can be correctable, it can affect your ability to be extended credit or get the best terms available when you are looking for credit. Okay, and then with that, I'm going to talk a little bit about your exclusive Affinity benefits. And first up is cost savings. If you're looking to purchase or refinance primary home or second home, we do have discounts on your closing costs. This is in the form of administrative fee discount. So we're able to provide you with a 0.5% of your loan amount as a credit towards your closing costs, which can go a long way when you're looking to purchase a house. We also can double up that savings by having participating realtors. And please reach out to the HomeStreet. Please reach out to us here at HomeStreet if you are looking for exclusive workplace checking, or if you're looking for a new vehicle loan or personal loan. We do have interest rate reductions available for University of Washington employees for the new vehicles and personal loans. We are also a great resource for down payment assistance information. Any of the Affinity loan officers are here to help you navigate the down payment assistance programs that are available in your specific area. Keep an eye out for additional financial fitness tools and resources throughout the year. We have a website on the next slide that will take you to your exclusive benefits and show you what's going to be available in the upcoming months. Remember that these benefits are available to immediate family members also. So if you have parents who are looking to downsize, or children who are looking to buy first home or next home, whatever it is, as long as you're an employee of the University of Washington, they're entitled to the same cost savings that you are. So reach out to an Affinity loan officer like myself, and we'll be able to help check if that's something that's available to them, and then help them through the process as well. And this is exclusive access, so you need to talk to me at HomeStreet here or another Affinity loan officer if you're interested in those savings benefits. Okay, and with that, again, the website, homestreet.com/UW will take you to a breakdown of your Affinity benefits here at HomeStreet. Again, my name is Ryan Cooney, loan officer here at HomeStreet. and I'll turn it back over to Sebastian. And thank you guys for attending. And I'm here for whatever questions you guys have.
Thanks, Ryan. We did get a few questions here, especially about improving our credit.
Yeah.
Whitney asked, first one, will a HELOC help improve credit? And is that considered a personal loan?
A HELOC is not considered the personal loan. It is secured. So it's a home equity line of credit. So it is secured to your home. So it is technically considered a mortgage. It's under the umbrella of mortgage, but it's not a, it's considered under the umbrella of a refinance because you are using the equity from the home. Whether or not it can improve your credit score depends what you're doing with the money. Because oftentimes people are using home equity lines of credit to consolidate a lot of credit card debt. If you're removing those revolving credits, having those down and putting those into a secured loan, sometimes you'll see a boost in your credit score that way. And then, of course, as long as you're paying everything on time, um, then yes, it can help you improve your credit score.
Wonderful. Thanks, Ryan. I believe
Mhm.
you may have addressed this question earlier in the presentation, but if it's all right, I feel like it might be good just to cover
Yeah,
anyway, if
yeah,
that's
that's fine.
okay. Um, how long does credit history remain on the report? For example, I have several accounts that are still showing on my report, but they're not active and have zero balances. If I close them, will it impact me?
So to answer that question, technically they're never off of your report. They're always going to be on your report that a payment was missed. What changes is when they factor in that late payment into your credit score. So generally, just one missed payment is going to negatively affect your credit score for about 24 months. If there are no other additional late payments in that time period, generally that gets dropped off. Just because there is a late payment reporting doesn't mean that it's one of the factors that's going into your credit score. So if this was something from, say, 7 years ago, yes, it's still going to show up on your credit report as a missed payment. But if you have on-time payments since then, it's likely dropped off by that point.
Gotcha. Uh, uh, Apologies, Ryan. I think I think I might have misworded it, but I think the question was like, if they close an account with 7 years of credit history, even though they don't really use the account and it carries a zero balance, is that going to be a negative impact if they close it?
There would be, I would keep it open, just because it's still giving you a benefit of having the credit history longer. I think that's what you're asking. So
Yeah, understood. Thank you.
yeah, if they're not going to continually, if it is from 7 years ago from late payments, they're not going to continually ding you for something that happened 7 years ago. But you can show that you've had credit history going back 7 years, which I think would outweigh a missed payment from 7 years ago.
Got it.
Yeah.
Um, and Rose asks, is there a penalty for incorrectly disputing something on my credit report?
So you can dispute, and then it's removed from the equation of calculating your FICO score. Now, they can, the whoever is granting the credit can come back and say and disagree with you, and it can remain in dispute. If you're applying for certain credit, they may ask you to remove that dispute before they can, because they'll if it may cause an incorrect credit score if the dispute is in fact um, correct in that you did say, just for example, miss a payment. You can't just uh, request to have a missed payment disputed with no evidence. They will come back and say, no, they have their chance to tell their story and say this was a missed payment. And then that can say resolved. Or if there's like, say, a collection or something like that, and you're disputing the amount on there, um, that could get resolved. Um, but I don't think, uh, to answer your question more directly, um, there would not be a downside, but you might likely um, be overruled, basically. Yeah.
Got it. Thanks, Ryan. Then Whitney asked, does it help to pay off? We have a personal, kind of a leaning into a personal finance adjacent question here. Does it help to pay off one or two credit cards in full if I have the extra money, or would it be better for my credit to make a few monthly payments on the card, even if they have high interest rates? Um, I'm aware that
So
like people with like Dave Ramsey, they would advise like, hey, debt is bad, just pay it all off. Don't pay any interest. But
if you're
I'm
if
not
you're
sure if
paying
that.
off in full, that counts as your monthly payment,
Hmm.
if I'm interpreting that correctly. So I would, if you have the ability to always pay your credit cards back down to zero balance, I think that would be ideal.
Yeah. The biggest thing is just don't miss the payment, right?
Right. Don't miss the payment and try to not keep the balance close to the limit of the credit card carrying over month to month.
Right. That probably wouldn't look good if you're holding like a 90% utilization there.
Utilization, yeah.
Um, Thank you. And then Amy asked, is there an ideal percentage of credit limits to not spend or surpass each month to optimize your credit score? Oh, that's a great question.
For credit cards, it is 25%. And what the credit score is looking at, if you have, because the credit report also knows your income. So if you are starting to get way more payments than you have monthly income coming in, they're probably going to try to slow you down a little bit too. So that's more of a personal question on where you fit into your personal income level and how much debt that you are carrying.
Got it. Uh, and then Luna asked, there's a two-pronged question here, so I'll ask them just one at a time. This one I think you also addressed earlier as well, but if someone only has a bank account with a debit card, do they get a FICO score?
Depends on the institution. The debit card is not one of the accounts that gets reported to the credit reporting agencies. So that's your Equifax, TransUnion, Experian, because the debit card is basically is just tied to your checking account. So you're paying for that upfront. It's just pulling the money right out of your account. So that's why a credit card, you're paying, like Visa or MasterCard is actually making the payment and then you're paying them back, is how the credit cards work. So that's why that gets reported to. Um, if it's a buy now, pay later, that's a reporting credit line. So that's all things like cars, personal loans, student loans,
Mhm.
anything you put on a credit card, mortgage, lines of credit, those things.
Yeah, I'm guessing also like, Klarna is and like Affirm, one of those newer like buy now, pay later programs when you
Right.
go to check out
Yep.
on something online. Those things probably
Yes.
get counted too, right?
Yeah.
Very cool. Um, let's see, another question here. Do utility and insurance monthly payments help improve credit? Um,
Great question. They can help I've seen that a lot with like, I think it's the Experian Boost, something along those lines, where you can manually add your utility bills onto the credit report. This is something that's helpful if you don't have a ton of credit. If you have, say, a couple credit cards and one other type of installment loan, I don't think that type of credit maintenance that you're doing is necessary. It's not something that gets considered on mortgage credit reports necessarily. Um, and that goes more towards so it's basically a way to add more data to your algorithm of your credit score. So if you're finding yourself shallow in the amount of credit accounts that you've had history of reporting, that might be a good idea for you. May or may not help you with a mortgage necessarily, though. And I think I'm going to follow up on that with one more point about the FICO score that you see on your, say, with your bank account or with a credit card that you have is a consumer credit score, and a mortgage credit score is different from a consumer credit score. So a consumer credit score is taking the score and calculating it with the percentage of debt that is collectible through collections. Whereas a mortgage credit score is looking at the probability based on your credit history that you will 30 days behind on a mortgage payment. And those scores are going to be different. They use a different scale. So if you see, say, Credit Karma says I have an 800 credit score, and I come back to you and I say, okay, your credit score is 780. And you're going to ask what that difference is. That's because we're using a different way to calculate those two scores. And a 780 on a mortgage credit score is probably just the same thing as an 800 that you would see on a consumer FICO score that gets reported through your credit card.
Oh, very interesting. Thanks, Ryan. Yeah, a couple new learnings. I didn't realize that you could add insurance and utilities onto your credit score. That's very cool. Um, Evan asked, as your credit score increases over time, should you look to take advantage of loan repricing programs? Uh,
Um, yeah, absolutely. I think that happens all the time, especially with refinancing your home. If you bought your home when you had no credit history and now you have great credit history, but that's also taking into account what the current mortgage rates are. If you have outstanding debt on something that was when you had a lower credit score, you can absolutely seek to see if you can get new terms on that. And I think that's a great idea.
Thanks, Ryan. I want to ask, so when your bank offers to increase your credit amount, do you recommend to take it or not?
Yeah, I don't see why you wouldn't want to. You don't have to use credit that's on a credit card, so they're just raising that ceiling for you. And so maybe they're asking you because you're getting close to the credit limit. So I wouldn't just keep opening that up just for the sake of borrowing more money. But if they want to give you more credit and you're not going to use it, I think that's just fine.
Right. Yeah, because that ultimately that kind of lowers your utilization rate because you have
Right.
access to more money, but you're not really spending more. So it just
Yeah.
shows you using less of it.
Mhm.
Very cool. Uh, Lori asked, let me see here. Okay. Uh, I think we also addressed this one earlier. When accounts close, do those years count towards the credit history? Say, for example, they had a credit card that was closed recently that was like really old, but now that it's closed, is that still calculated into your credit history, or is that just gone for good?
So it's always going to be on the credit report. I would recommend keeping that open, especially if there's no annual payment, just because you get credit for all that time. If you've closed the account, it's only going to show you the score is skewing towards your accounts that are active. Um, so yeah, if you can keep that open and it's not, even if it's you're not making any purchases on it or and you don't have any payments, then keep it open and it's going to help you with your credit length of history.
Got it. Thank you.
But you still get credit for all the times that you did pay in the history of having that credit card. I guess I should add that too,
Oh,
because that was part of the question. So
got it. Yeah, that's good to know. And would you say, I guess, healthcare bills, are they also reportable on credit reports? I heard that there are some laws that might omit them.
correct. Those are omitted. That is a recent change as of 1 or 2 years ago, I think. But the medical bills are no longer on your credit report.
Got it. Thank you, Ryan. Let's see. Again, I guess another HELOC related question here as far as how is
Sure.
credit score needed uh, for a HELOC to be determined? Uh, is it the same as credit cards?
So what is asking for the minimum credit score for a HELOC? Is that what you said?
Yeah, I guess they're
Okay.
just interested in how credit score is calculated if they wanted to get a HELOC. Like, how is that a part of the calculation to
Yeah,
determine?
that's going to be that's going to be more of the mortgage credit score. That
Hmm.
is going to be if you are doing a typical purchase or refinance, we do pull a tri-merged report, which is all three, and we take the middle score. If you're doing a HELOC, we just pull from one credit bureau, and that's Experian, and that's the credit score we go with. And typically, right now, So always inquire on what the minimum FICO scores are. Right now, we do require a 700 credit score for a home equity line of credit. That's the minimum, and then your price gets cheaper with every 20 points that you go up from there.
Mm,
Um, but yes, you're using the mortgage calculated score for that FICO score um, when you're applying for a HELOC. And different institutions might use different minimums, or they might use TransUnion or Equifax, but we use one credit pull for um, HELOCs, and that's Experian.
thanks, Ryan.
Mhm.
Uh, looks like we have a question about student loans. How
Okay.
do student loans impact credit? Is it possible is it possible for them to have some type of positive impact if I'm making my payments?
Yes. So that's an installment loan, is what those are. So it's good credit history as long as you're making the minimum payments every time. Um, Depending on, I know that was 2020 to 2023, 24. There was a deferment on those, so they were not reporting to the credit bureaus. So there's going to be a gap, but that's totally fine. As long as you're making your student loan payments on time every month, you're adding to your credit history. So it's positive effect there.
Yay. Thanks, Ryan. So
Yeah.
there's another question here about debt consolidation as well. Are debt consolidation loans recommended if a person has close to 50% of their income in consumer credit? Um, and there's another part, but we can focus on that first half for now.
Yeah, so what I would say is that would be a question for a credit counselor, and that's one of the things that we can send out. I think I'd rather just send that out to the group after in
Hmm.
terms of who some credit counselors are that you can talk to about those sort of things that specialize in that type of analysis on debt consolidation. But I would say the most thing is if you're feeling like you're struggling to pay those bills or make any progress on paying the balances down, then that might be the time to talk to a credit counselor. So
Absolutely, because every situation is unique. So
yeah. Mhm.
thank you. Also, not sure. I guess the second part of that question is just kind of pandemic related.
Sure.
Would you know of any like considerations that are being made because of the pandemic and how, uh, I guess, unique of a time that was and how that may have affected everybody's credits? Like, are there any concessions that are made for your credit score, if you would know?
I think that's more of a case by case basis. If you were asking for things or given deferments during COVID, that is what you would call. So in the event that that's the only negative of credit event in your credit history, and that's what's preventing you from, say, getting a loan, um, that would be uh, what would be considered an extenuating circumstance, which, if eligible, they can explain away that one bad credit event with a one-time event like a pandemic that would result in that type of negative credit event history in your credit history. Um, so it's kind of a case by case basis on what you're specifically looking for. But if it is something like just missing payments during the pandemic without any other explanation, I believe that's just treated as a missed payment. But you can reach out to me after individually, and I can see what's kind of going on, and we and see if there's something I can do to help on that.
Thanks, Ryan.
Yep.
And would do you have any strategies for credit building after bankruptcy? If you say you filed for bankruptcy, what can one do from there? Um,
Yeah, so I would go back to that, and I'll send out that specific slide with the percentages of what goes into your credit score.
mhm.
And if you can build based off of that with your own individual credit needs, whether that's you know uh, on-time payments, whether that's building different types of credit diversity, or the utilization of credit. and kind of plug in those and see what would be best for you. I and then it does also depend on what you are looking to do after bankruptcy. Um, Certain loan programs are available after, I believe, 2 years. Some you might have to wait 4 years before you can buy another house. I'm not sure what exactly the requirements are for getting more consumer loans like cars or credit cards, but I can answer specific questions related to mortgage purchasing after a bankruptcy has been filed. It's generally just a waiting period.
Understood. Thanks, Ryan.
Mhm.
Let's see here. Oh, I just want to touch on this question real quick from Lori. I think they wanted to re-clarify. They said that their bank moved their I guess they had a credit card product from this bank and they moved it to another one. Perhaps they were just retiring like a sunsetting an old product into
Sure.
a new one and they got moved to that new one. Does that affect their credit history now that they have that new product? The account is still open, but it's just
Yeah.
called something else now.
I don't think that would have any negative impact on your credit history. It should, yeah, it should be identified. That would be one that I would take a look at what, pull your credit report on annual credit report and see what it looks, see how it shows up in that credit report. Does it say account closed? Is it more likely it says account transferred? And it might just continue that credit history going forward from there.
Hmm.
Mhm.
Got it. And then another question here about is the commercial credit report that is pulled when looking at a new car loan the same as a home commercial report if you're getting a home loan?
No, those ones are different. That's more along the consumer credit, like because they're looking to see if they can recoup the value on that car,
Ah, understood.
right? Mhm.
Thank you. And then I guess one last question here. Actually, I got maybe perhaps two, but I'm not sure. Uh, if we let's see here. Uh, how many credit cards do you recommend that somebody have? And I think this one also kind of depends on their unique situation as well.
Sure, sure. Um, you can have at, at least one so that you can show that you've been extended revolving credit. Um, Even if it's just put one bill on there and pay it back down to zero balance every single month. Um, I would say that if you have more than north of like 7 credit cards, that's when I start to see the notification pop up that says too many accounts with balances. You can have 7 credit cards open and have no balances on them, and that's fine if you like only use 2 or 3 of them. But if you have 7+ credit cards all with balances on them, that's when I start seeing the notifications that too many accounts with balances popping up as a reason for the score being lower.
Hmm. Interesting. So having two, even if you make the payments on time and you have like
Mhm.
multiple credit cards, you do get a notification for that.
Yeah. They're always on every single credit report that we pull, they put, even if you have the perfect score, they're going to put the top 3 things that are negatively affecting your credit report on there. So they're always finding something to bring the score down. One of those options I do see a lot is too many accounts with balances as a reason why your credit score is not above, say, and this is like talking about scores that are still that can still be great scores. It's like you can still have a like 780 credit score and it says too many accounts with balances. So it's not necessarily a huge impact, but that's something that they do consider into the calculation of the score.
Hmm. Hmm. Got it. Um, and then I guess only two questions left here. One is
Okay.
if you get denied a consolidation loan, is it when would you recommend it would be a good time to reapply? Like 6 months?
Depends on the reason for the denial. Um, so that's when one that I would seek a legitimate credit counselor, which we can get out to everyone who attended this after.
Got it.
Yeah,
Awesome. Well, I believe actually, that actually is all the questions
great.
we had. So if anybody has any more questions, this will be our last call for questions here. Otherwise, I just want to take the time to thank you so much, Ryan and Valerie, for today's presentation and answer everybody's questions on credit. Um, Again, I will be sending out the slides to today's presentation as well as the recording. Um, and oh, we did get one more question. Oh, uh, will paying off my student loans negatively affect my credit score if I'm looking to purchase a home?
So, um, depends on, so if you're paying off a something like an installment loan, like a student loan, closing out an installment loan does not have the same effect as, say, closing out a credit card for good, because you've been granted a fixed amount of money, and now you've settled that debt as whole. So it's not going to affect your credit score negatively. What it does, what you may want to look at is is it something that you're doing because you think that it will improve the purchasing power that you have for buying a home. The answer may or may not be yes or no, just because that would be something you can take a look at with loan officers such as myself and say you're qualified for the house as is because we're only using the minimum amount reporting to the credit bureaus, or you wanted to buy a house worth this much, but we can't do it with your student loan payments. They're too high right now. So if you have money, instead of putting it more towards down payment, why don't you get rid of this debt and then you qualify for a higher mortgage payment and you can get that house that you're looking for. So it's not going to negatively affect your credit by paying off those loans, but it may help. But do you want that cash for for something else, or do you want to have like purchasing more of a home, or can you wait and see what's going to be a better option for you when you consult with a loan officer on your when you're looking to buy a home?
Understood. Okay. Well, I believe that's it. Well,
Okay.
thank you so much, Ryan,
Yeah.
yeah, for answering everybody's questions there. And yeah, I would like to give everybody back the gift of time. Be sure to check out our last financial literacy month event next week. We'll be closing out here with about investing. So again, thank you so much, everybody, for joining. I hope you all have a wonderful rest of your day. Thank you so much again, Ryan and Valerie.
Yeah. Thank you, everyone.
Yeah, take care, y'all.